When should you start withdrawing from your RRSP? You spent decades building up your RRSP. Once you retire, everything flips. Instead of saving into it, you need a plan for taking money out. And the timing of those withdrawals can have a huge impact on how much of your savings you actually get to keep. I'm Nick Hearne, financial advisor and portfolio manager at RGF Integrated Wealth Management. In this video, I'll start by explaining how the RRSP withdrawal phase works and what to consider when creating a withdrawal plan. I'll then show you how this planning is actually done by walking you through a case study. An RRSP is for saving and growing your retirement money on a tax-deferred basis. At some point, that money has to come out, and that's where a RRIF comes in. You do also have the option to convert your RRSP to an annuity, and that can make sense in certain situations, but RRIFs are essentially the withdrawal phase of RRSPs. Your investments stay tax-deferred while inside the RRIF, but the withdrawals are fully taxable. And there's no minimum age to convert your RRSP to a RRIF, but you must do it by December 31st of the year you turn 71. Minimum payments start the year after conversion, which means the year you turn 72 is the latest you can wait before you have to start drawing an income. So the real question is, should you start withdrawals earlier? If you're retired and need the money to fund your lifestyle, then that's what it's there for. And there's nothing special about age 72. If you're married or in a common law relationship, it's at age 65 the RRIF income becomes eligible for pension and income splitting. You'll recall this is a mechanism that enables you to reduce your overall household tax bill by shifting income from the higher earning spouse to the lower earning spouse. Now, if you have other options for sourcing your income, things get more complicated. Remember, RRSP money has never been taxed, and it will eventually be added to your income. But what you may have some control over is the tax rate that's applied to that income. By taking smaller withdrawals earlier, you reduce the size of future mandatory withdrawals, which helps keep you out of higher tax brackets later in retirement. While withdrawing earlier can actually increase your after-tax wealth, it can be emotionally difficult. From decades of saving, we're programmed to think the smart move is always to minimize and defer tax. So paying it sooner, even when it saves more in the long run, can feel counterintuitive. That's why it's so important to look beyond the immediate tax bill in current year and focus on the bigger picture of what leaves you and your family better off in the long run. Large mandatory withdrawals at 72 could also trigger old age security clawback. So smaller, earlier withdrawals can also help preserve your benefits. Later in retirement, income-tested costs for things like assisted living can have a similar effect. Higher taxable incomes can mean paying more for care. And then there's the question of reinvestment. If you don't need the money, where will it go once it's withdrawn? Do you have TFSA contribution room to shelter it from tax? Or would it end up in a non-registered account where the growth is now taxable? This is where detailed projections comparing long-term outcomes are needed, and this is best seen through a case study. David is 63, lives in BC, and has recently retired. His annual retirement spending is $60,000. He has a $1 million non-registered investment account with a cost base of $700,000 and an RRSP with a value of $800,000, which he plans to convert to a RRIF at age 71. For both accounts, his projected annual investment return is 6%. He's eligible for the maximum OAS and CPP benefit, which he plans to defer until age 70. David withdraws from his non-registered accounts to cover his spending needs. His taxable income is made up of investment income from his non-registered account, and for the coming year is projected to be around $47,000, putting him in a marginal tax rate of about 19%. His income is projected to remain in this range for the following 6 years. At age 70, he starts receiving CPP and OAS, increasing his taxable income to $86,000 and putting him in a 28% tax bracket. His income jumps again at age 72 when the minimum required withdrawals from his RRIF start. This puts his taxable income at just over $150,000, resulting in a marginal tax rate of just over 38%. At age 72, we also see a drop-off in David's OAS pension. The RRIF withdrawals have increased his income over the OAS clawback threshold, and his benefit is starting to be clawed back. To account for this, we want to calculate David's marginal effective tax rate. This factors in his marginal tax rate of just over 38%, but also the 15 cents of OAS clawback, and works out to about 47.5%, which is significantly higher than his current marginal tax rate of 19%. And so the question becomes, should David continue this tax deferral strategy, or would he be better off smoothing his income over time by starting to withdraw from his RRSP early? Now, this income smoothing strategy is optimized around maximizing David's after-tax wealth and not minimizing the total lifetime tax David pays on his RRIF withdrawals. This is important to differentiate because we need to recognize that by withdrawing from his RRSP, David will have a larger balance in his non-registered investment account, where the investment income he earns is taxable to him. In our income smoothing strategy, from age 63 to 69, David withdraws enough from his RRSP to take his income to the top of the 31% income tax bracket. He covers his remaining spending needs by withdrawing from his non-registered investment account. At age 70, David reduces his RRSP withdrawals to bring his income down below the OAS clawback threshold. At age 72, he's required to take a minimum amount from his RRSP, now RRIF, and this pushes his income into OAS clawback territory. But the clawback amount is less, and he's projected to receive more in government benefits. The income smoothing strategy projects higher income for the first 9 years and lower income tax for David's age 72. This is projected to net to $142,000 less in lifetime taxes paid, in addition to the $112,000 of OAS clawback that will be avoided. So there's no minimum age to start withdrawing from your RRSP, but you have to convert your RRSP to a RRIF by the end of the year you turn 71 and start withdrawals in the year you turn 72. The right timing depends on your goals and financial situation. If you're fully retired and need the income, it likely makes sense to start withdrawals earlier. That's what it's there for. At age 65, you can start taking advantage of income splitting opportunities. When you don't need the withdrawals to cover your spending needs, detailed projections can help you build a withdrawal strategy that maximizes your after-tax wealth. Tax smoothing, benefit preservation, income-tested care, and where the money will be reinvested all have a role to play. If you're planning your retirement income, our free toolkit includes helpful resources and worksheets. You can download your copy by clicking the link in the description below. And if you found this video helpful, please like and subscribe for more content on Canadian retirement planning.